Is the market about to tip over? In this video, we'll unpack why caution is the way to go after the surprising drop in producer prices and that spike in retail sales, which might not be as rosy as they seem. We'll also look at Jerome Powell's warning about renewed supply chain shocks, explore how traders are positioning, and reveal why this time could be the perfect time to lock in profits before the next correction. Plus, we'll break down Trump's big Middle East investment deals, the dollar's fragile bounce, and Bitcoin's tight range. I'm Ivo, Debt Stocks Chief Market Analyst. Let's get to it. First, let's start with the mixed PPI and retail sales. On one hand, the producer price index posted its largest month-over-month drop since 2020, and retail sales remained surprisingly robust. Both developments that briefly undermined any talk of stagflation and supported a modest market uptick. But a closer look reveals that these figures may overstate underlying strength. A significant portion of April's PPI decline, 6.9%, came from portfolio management services, marking the steepest fall for that component since 2022. The drop was largely driven by the recent equity sell-off, yet markets have rebounded and we should expect this PPI subindex to bounce back in the future releases. Likewise, the apparent resilience in retail sales likely reflects a pull forward in spending, with consumers and companies stocking up ahead of the new tariffs proposed by the Trump administration. There is evidence that US consumers are pulling spending forward and that companies have been stockpiling before the tariffs hit. So the full impact will start to emerge in due course. Before we continue, make sure to click that subscribe button and ring the bell so you do not miss any of these videos. So, last week's data offered near-term market lift. Its durability is questionable. Even as we pass these figures, Fed Jerome Powell added some nuance. Last video, we were monitoring potential supply chain risks and the risks that seemed to ease after the weekend de-escalation in US and China tensions and a rebound in container shipments. The hope is that calmer relations will foster deal-making between the two nations. But the rally in equities does not eliminate the threat. Without a lasting agreement on broader tariff relief, a renewed contraction in shipment volumes could still trigger supply shocks. And the head of the Federal Reserve, Jerome Powell, acknowledged this explicitly. I quote, "We may be entering a period of more frequent and potentially more persistent supply shocks, a difficult challenge for the economy and for central banks." That remains a risk to track, and even if recent progress has dulled the immediate sting. Looking at positioning, the VIX remains suppressed with tailwinds supporting equities. In fact, the prevailing volume selling bias is propping up stock prices, and any uptick in the VIX is met on by hefty selling, quickly driving volatility back down. With VIX expiration this week, we will need to reassess positioning afterwards, so keep this in mind. Despite the supportive technicals, I continue to be cautious and taking and trailing profits for a rotation into cash. Yes, fundamentals have improved, and the US-China talks, the Trump successful Middle East diplomacy, and the promise of future deals perhaps with India upon his return. But these developments lessen the odds of a slide back into bear market territory. Yet we are arguably near a local peak and correction seems overdue. Several items on my fundamental checklist remain unresolved. A ceasefire in Ukraine, for instance, this has stumbled recently after Putin skipped the peace talks in Turkey and sent a delegation of non-decision makers. On the sentiment side, the CPC, which is the put-call ratio, 5-day simple moving average. I know this is a mouthful, but this is flirting with the 0.5 threshold, and these levels have marked local highs in the past, and many overbought indicators, such as the percentage of stocks above their 20-day moving average for the S&P, and many overbought indicators, such as the percentage of stocks above their 20-day moving average and the bullish percent index, are near multi-year highs, even as they can stay elevated longer than oversold readings, they still need to be monitored. We also watch the VVIX alongside the VIX. VVIX is the volatility index of the volatility index, which has bottomed out, even as VIX drifts lower, hinting at potential grind higher in volatility post-expiration. Skew remains elevated too, so this is suggesting we should be alert for shifts in sentiment. Basically, risk-reward increasingly favors trimming long positions now rather than waiting for a sharper pullback. Selling into strength rather than into weakness helps us avoid being caught off guard, and just as many people got caught off guard last time. So on geopolitical developments, last week's headlines built on earlier wins in the Middle East. Qatar sovereign wealth fund plans $500 billion of US investments over the next decade. The UAE president announced $1.4 trillion in US commitments. This is a preliminary deal which grants the UAE an annual access of 500,000 of NVIDIA's most advanced AI chips from 2025, and a US-UAE AI campus partnership, which will engage multiple American tech firms. These moves should inject liquidity into the US tech sector for the medium term, though near-term market bumps remain likely. In FX market, the dollar index bounced perfectly from its zone but remains capped by its downward trend line at the 50-day EMA. Demand for dollar has increased, but overall sentiment is not decisively bullish. Corresponding pairs like the euro dollar and the cable, which is the pound dollar, mirror this mixed mood, suggesting a sideways chop ahead. In crypto, I am seeing renewed optimism around Bitcoin ETFs. Volumes for ETFs were heavy on Friday, while Bitcoin has been consolidating under resistance in low volume trading, holding its 9-day EMA. This is a tight range and it continues to persist as traders hunt for liquidity, with skew tilting towards higher prices. To summarize, the market's recent rally has boosted sentiment and calmed some risks, but many indicators warn we are close to peak. The balance of probabilities favors a correction, making now a prudent time to lock in gains and build cash reserves while maintaining selective exposure. Well, that's it for today's video. Thank you for your time. Remember to subscribe, click that like button, and see you next week.